All right, ladies and gentlemen, here we go. The first episode of TCP of the year 2023 about to get underway. This is going to be a big year for us. Recently, we've been talking about the progress that we made in 2022 and to think how far the podcast has come, how many different traders, how many different individuals, businessmen who we've gotten the chance to interview and meet and network with, and at the same time have been able to share their knowledge with all of you. It's honestly, if I look back 12 months or when we started the podcast in late 2021, it was honestly unimaginable. And we always had the vision of doing something like this, but to see it really start to come together, and I do feel that, again, we are really just getting started. It's exciting. It's a very, very exciting time for TCP.
Yeah, first of all, Happy New Year and Happy Holidays for everybody that we haven't seen in a couple weeks. But yeah, 2022 was just such a great, I think we learned a lot and we shared a lot, and I expect 2023 to be no different. I already know that we're going to make so many amazing connections with so many great traders and so many great minds, over the next several months that we're going to be able to share with you guys, and so that's what makes me excited. But this interview today is going to be amazing. I know it is, and I'm excited to get into it, so let's do it.
All right, let's bring him in. The first interviewee of the year 2023, Money Mander. Welcome back to the pod. How you doing?
Good. You guys are making me feel all special and shit. First one of the year. It's good to be back. I think it's been almost a year since I was on, excluding the the whole trader panel we had with all the Kane guys. It's been about a year.
Wow, I didn't even know it was that long. A lot has changed. A lot has changed.
I think it was How to Trade SPY with Money Mander, episode 18.
Yeah, How to Trade SPY 0 days with Money Mander.
18.
Classic,
That was a ripper. All right, brother. So let's just start talking about what you've been up to over, the past 12 months or so since we had you on. How's the trading been going? The market obviously looks extremely different. You're very vocal. You've become more of a perma bear over the past 6 months. I think we've seen that on your Twitter, on our new morning show, Beat the Bell, in the Discord. Just talk about, your mindset and how it's evolved as of late.
Yeah, it's pretty crazy. I was thinking back, 12 months ago, what all has transpired. I mean, 12 months ago today, I was still working my 9 to 5. It's really just crazy what all happened for all of us in the whole group, but me individually over the past 12 months, just been unbelievable. But as far as the perma bear thing goes, right? Like, I put on the facade, I think, a little for Beat the Bell for the entertainment purposes, but really all that comes down to is 2 years ago, I was the biggest perma bull, and then as economic conditions change, I have to adapt with the climate. And so that's really all that comes from. I'm pretty vocal in giving out some pretty aggressive thoughts, I think, but that's really all that is to me, bottom's not in, so I'm not in any rush to get long, and I think I just kind of spice that up a little bit.
The funny thing is, in a bull market, everybody loves you for being a perma bull. In a bear market, everybody hates you for being a perma bear.
Right?
But you're very realistic and you give it how it is. People don't want to hear that, though. Everybody wants to see stocks go up. So unfortunately, you're putting yourself in a position where you are going to get and take a little bit of heat. But you've been right, dude. Like, a lot of what you're saying, and I've personally really opened my ears to what you're saying, and I'm starting to learn from you because you have such a strong background in macro, and it has really helped me to sort of understand the environment, which is translated over into my trading, because a lot of what we were able to do during the year 2021 and 2020 was kind of just trade blindly. You didn't really have to understand what was going on below the surface. You just knew that stocks were going up and you knew what to trade and when, and things were just a lot easier. Now we have to take into account what the Fed is saying, economic conditions. And so I think that what you're doing is educating a lot of people. Whether or not they want to be open to that is up to them. Some people try to ignore it, and some people try to say, anybody who's a perma bear who's negative, they're just negative because they want to be negative. But realistically, there's an opportunity to learn. So I will commend you on that front. I think that you're helping a lot of people understand what's really going on below the surface.
That's the thing. I feel like Morpheus in the Matrix, like red pill or blue pill, right? Some people just don't want to listen to what I'm saying, but And it's like I get this facade put on me as if I'm some like angry person because like I hate the stock market and I think the stock market is going to go significantly down from here. Like, no, it's not at all like that. And I try to think like I'm just putting out my opinions and like the data that I'm looking at, but and that pisses so many people off. Like I'll put out a bearish data point or something, macro focused, and the bulls come at me. They're all in the DMs and everything. Like, dude, blah blah blah. Like, what would make you more mad? Would staying on the sidelines and seeing the market go down, or like you being a perma bull and I'm a bear? Like, does that make you more mad? Or would buying Amazon, all the perma bulls said post split, Amazon's going to like 4,000, right? Like pre split numbers, and now it's trading at 1,600, right? Like, what makes you more mad?
All right, so to talk more about trading, I want to ask you about your 2023 goals. So everybody kind of comes into the new year fired up. I know personally I'm excited. I'm ready to go. I have some goals in mind. What is it that you're really going to be focused on based on what you learned from your trading, from the market, from a macro standpoint in the year 2022? What are you carrying over into this year, and what are you most focused on?
Yeah, so my biggest thing, I haven't really put this in like a SMART goal format. I think that's what they are, right? Like specific, measurable. My biggest thing is just consistency. I look back at 2022 and not in terms of like, a monthly goal or everything. I think I've said that many times is I don't like to trade with a daily goal, a monthly goal, because I think that can, if you're in the hole, that has you trying to trade out of the hole when you shouldn't be, or in the other boat, right? Like if you're in a great trade, then you're getting out too early when you shouldn't be, as long as like the trade hasn't invalidated itself. So I never trade in that kind of respect. But my biggest thing is just trading on consistency, I think, because I was trading a lot of 0 days last year. And obviously, I think that's why the last podcast blew up that I was on here a year ago today. We were just destroying SPY 0 days. But as liquidity's dried up and the market's gotten a lot harder, especially on 0 day volatility, I've tried to kind of stray away from that and use my edge in the market, right? And what's my personal edge in the market? I think it's a fundamental understanding of the macroeconomic climate and where I think stocks are going to move in the longer run, right? Within the next day, the next 2 days, the next 3 days, who knows, right? And so it used to be all TA based trading. And that's kind of, it's tough now, right? Like you can't just ride the ADMA for a full day now and have a trend day. Trend days come a couple times a month anymore. So 0 days towards the end of last year were getting really rough for me. So I think my biggest goal is, and I've already started doing this last month, is getting into more just buying time, trusting my conviction, and finding consistency in that way, because I think that's where my real edge in the market lies. And I wasn't, utilizing that. So that'll be my biggest goal for this year is, not trying to hit the 10,000 or the 2,010 bag trades that I kind of blew up for, right? Because I don't really care about that anymore. It's really for me now is just finding consistency, having that higher hit rate, and ultimately capturing bigger moves, because you can capture 50 points on a 0 day and have a 10x trade, but I think it's way cooler, in my opinion, to capture a 30-point swing to some side on like Apple. Like that, I think that's way cooler. It shows a better understanding of market conditions, which is really what I'm going for this year.
If you look at it in terms of incentives too, you were probably, and I know for a fact that you were incentivized to take those shorter dated options, because it's like, okay, I have a pretty decent understanding of the macro environment. I can use that to my advantage, for my trading, but Nvidia's down 5% today. I could have taken a 0 day and I would have made 500%, right? Like that type of thing. And so you were more incentivized to move away from your strengths and sort of chase that weekly volatility, as we've talked about so many times. Like you said, when that sort of shifted towards the end of 2022, I think, and you and I had a conversation about it where it's like, here's what I'm good at. I have to use it, right? Like if I'm not using it, like what am I doing here? Like if this is my strength and I'm not using it to make money, then there's no point in me doing this. And so I think that sort of like that level of self-understanding and self-awareness, I think, is really important if you're going to do this over the long term, right? Like you have to understand yourself as a trader and as a person, I think, really on an intricate level to be able to make those sort of subtle shifts and changes, because those little small tweaks are like what's going to save your account like in the long run, I think.
Yeah, absolutely. And it's kind of like exactly like you said, it's that shoulda, coulda, woulda. How many times, I can't even tell you how many times, like last year I would go back and it'd be in hindsight a post move and I'd be like, damn, look at NVIDIA down 5% today. Let me see what like the 140 puts went today. Right now I'm looking at it and you just get that in your head like, oh man, those 0 days of volatility is there. But at the same time, if you're on the wrong side of that, your risk to reward is it's destroyed, right? Whereas if I'm getting in a swing play, you still have 3, 4, 500% upside of, like, if I'm targeting the right strike with intrinsic value of where I think it's going to go. But then ultimately, like, my downside's not there. I can keep a tighter stop. I can let the play pan out, give it some time. So that's really my biggest goal, is getting away from that and just utilizing my understanding, exactly like you said.
Let's touch on the 2023 outlook. So I know that you recently put out an entire paper on, not an entire paper, but like a short note on how you're feeling about 2023. I'd call it an entire
paper.
It was pretty long.
Pretty legit.
Right? It was pretty long. It was a nice outlook. If you haven't checked it out, at Money Mander or at Mander Trades on Twitter, go check that out. We'll drop the link in the show notes as well. But why don't you go ahead and tell us what you're looking at going into 2023, what you're sort of concerned about when it comes to the market, and what you expect over the next 12 months.
Yeah, so we had a really fun debate on this on Beat the Bell recently, which I think we formed it into a debate, but we're both kind of in the same mindset here, whether it's the end of this year, the start of 2024, we kind of bottom. Honestly, it could be longer than that, because I named the paper The Great Reparation, right? And to me, reparation is the paying and making amends for a wrong you have done. And that is exactly the position the stock market and the Fed is in right now. Is, dues are going to have to be paid for what happened. I ended the paper with unprecedented gains cannot continue without unprecedented downdraws, right? Everything in life is going to be a yin and a yang, and there has to be this parity. And so if the stock market wants to go up like 600 some percent from '09 lows to 2022 highs, that's not going to happen without a significant downdraw. It's just, realistically, the stock market's averaged 11% annually over like 200 years. It's not going to average 33% over the course of 13 years, 14 years without a significant downdraw. And so in the paper, I went in, I did a lot of dive into some macro aspects. I'm looking at the insane injection into the money supply we've had with 4 rounds of QE since 2008. I went into, the yield market right now with the 210 inversion and all of that stuff. It was a really good paper. It's not going to win me a Nobel Prize. I think it's only about 14 pages, but it exactly gives my outlook, where I don't exactly know where we end 2023, right? I think everyone's of almost the full conviction a recession is looming. How detrimental of a recession is tough to say, at least until we get some more clarity on how much it's going to take to crack this labor market, because so far they haven't been able to touch it. So, as sticky as inflation is what's going to determine how bad this recession is and how hawkish the Fed continues to have to be. But I gave some pretty aggressive price targets in there that got me some shade.
Why don't we talk about that, Mander?
Let's talk about that.
So very quickly, for those who didn't read the document, I'll just go ahead and spoil it for you. Mander's got 3 forecasts for 2023. Conservative. This is regarding the low of the S&P 500. So not necessarily how we're going to close the year, but Mander thinks that these prices will print before the end of the year. In a conservative estimate, he's got 2950. In a moderate estimate, he's got 2590. And in an aggressive estimate, he's got 2200. And
get the fuck out of here.
So we're at 3895 right now. So just some very quick math for our listeners. At 20, what was the first one? 2950. At 2950, that would represent about a 25% decline from where we are right now. At 2590, that would represent somewhere in the ballpark of a 33% drop from where we are right now. At 2200, that would represent a 43% drop from where we are right now. And that 2200-ish level is also the COVID lows. So when we bottomed during that COVID scare, that was the bottom in the S&P 500. So Mander is predicting, at the worst, a return to those COVID lows, those pandemic lows this year.
I think 2950 is probably the more realistic print for this calendar year, at least. 2200, I think, is definitely in play, but maybe not in 2023, just because that's a lot of price action to occur within a single calendar year. Unless we had something dramatic in the system implode like you had in '08, that'd be a big move to the downside just on systematic selling and capitulation. But 2950, I think, is very, very realistically in play. And here's my thing, right? Everyone's saying, how is it like there's no way we return to COVID lows. That's like 60% down from all-time highs or whatever it is, right? But no one is going back and saying, how is it crazy that we went from 2,200 to 4,800 within 2 years, right? in the midst of that should have been towards the end of the bull market to begin with. The Fed was already at the point where they had begun hiking rates back in 2018, I believe 2019. They were already getting to the point where inflationary scares were of concern. They were hiking rates, trying to put us in the position we're at now back then. And then boom, you have COVID, panic scare, markets dump off of fears of the global lockdown, and they're immediately put back in the position where they have to bail us out again, drop rates back to zero for another 2 years. Let me say this, right? The federal funds rate had never been at zero, like at or near zero, so 0 to 25 basis points ever. Ever. It had never been there. After '08, they plugged it there for 7 consecutive years. Then they began to hike again, and then COVID hits, they plugged it back there for another 2. So of the last 13 years, we've had 9 years with rates at or near zero, and they've never been there in history, right? And then on top of that, you had over $8 trillion worth of assets purchased and added to the Federal Reserve's balance sheet. $8 trillion, right? So the rate in which the money supply grew, I think that's really why we're still at this position with really sticky inflation, is that the money supply is at unprecedented levels off of this quantitative easing, which also has never been done. The Bank of Japan tried it for like 3 years in a very moderate dose. I think it was like 300 billion maybe, right? Max over the course of 3 years. We've dumped in 8 trillion into our economy. It's never been done before. And the real worry of that is this is more Keynesian economics, right? Versus a classical economic view would be you're looking for ultimately everything's a cycle and you just let it would be a hands-off approach, right? Like no direct monetary policy injecting. It would just be let the economy sort itself out. Ultimately, it's going to go through cycles like that, right? The Keynesian version would be this in direct monetary policy implementation with altering the federal funds rate and then quantitative easing. The worry of that before it was ever even put into use was the creation of massive speculative bubbles because of so much money in the monetary supply. You figure if there's so much money in circulation, so much liquidity, everyone's making more money. Ultimately, things are going to get dumped into these speculative bubbles, which is exactly what we saw with crypto. NFTs. I mean, come on. People were spending the price of a home on a cartoon ape, a little gorilla that you could trick out with necklaces. Like it's absolutely insane. And so it sounds aggressive right now, but then when you look back, right, what would 2200 be off of all-time highs?
2200 would put us at minus 54%.
All right, and so that sounds so crazy. We saw minus 50% in the S&P in the 2000.com crash. We saw minus 57% in the '08 financial crisis with the MBSs and CDOs. Like I don't really think it's all that crazy, especially when you consider where we're at, right? So we have inflation like we had in the '80s, on top of overvaluations of stocks like we had in the .com crash. You have like a dual synopsis here, creating this bubble we're really in. Ultimately, I'm kind of surprised we even closed the year at 3,800, only 1,000 points off. But I think it's just going to take time for this really to be felt in the economy. But unprecedented rate hikes haven't even touched the demand side of the economy yet.
Right. I mean, we talk about how sticky inflation is, and particularly how tight the labor market is in regards to, what the Fed is doing right now with interest rates and how they're sort of trying to combat this inflation by just hiking rates, keeping them in restrictive territory for as long as possible to hopefully, like you said, slow down that demand side of the economy. One of the things that I know that we were talking about, we were concerned going into 2023 this year, is that what happens if, I think a lot of people, the consensus is, okay, things are going to get bad, things are going to slow down, unemployment will start to tick up, and at that point, the Fed will say, okay, we've done enough to bring inflation down. We obviously can't risk some sort of Great Depression situation where unemployment skyrockets to the roof. Let's start to relax with the, financial tightening and whatnot. Let's just sort of, at a minimum, stop, right? Pause rate hikes, and at the most, a full pivot towards, bringing rates down. I think that's sort of everyone's like ideal mindset for how the markets will find a bottom here. What happens if that unemployment rate never starts to tick up, right? I mean, we could very well be in a situation where the Fed wants to remain in this sort of aggressive posture for the better part of 2023, which I think could really start to cause some problems for a lot of people's views on where the market goes this year. And Mander and I tend to be of the same mindset that the this year is going to be a rough one for the market. But I mean, dude, 2,200, like that's That's like scary territory. I don't even know if I really want to believe that.
That's shit your pants territory. I started off the podcast by saying, people don't want to hear that. Maybe I'm one of those people. I don't want to hear that. Don't tell me the market's going to 2200. But realistically, I mean, what? We're 23 years old. SPX at 2200 ain't so bad. We'd be loading up.
Right? Like, it sounds terrible right now if you're already long, but if you're not and you're sitting in cash, it just presents a great buying opportunity. And here's the other thing I'll say, right? It sounds so crazy, and everyone's saying, oh, if I could get in the S&P 500 at like 2200, man, oh my God, I'll be rich in a couple years. It's not necessarily that either, because if you bought the top of 2000 before the dot-com crash, you didn't see a tick of green for 13 years. Like, that's how long some of these speculative bubbles take to pan out. And then obviously, now had you long the top, you'd still be up now, but that'd be equivalent. Like I'm saying, if you had longed 4,800, who knows how this pans out? That'd be the equivalent of longing March 2000. You didn't see green until April 2013. So
I'm glad you brought this up. I've seen you be very vocal about the age-old saying, time in the market beats timing the market. I'm honestly curious because although, we're trading together all day long, I haven't asked you as of late how you're managing your long-term portfolio. Have you done any investing? Did you do any investing for the long term in the year 2022? And what are your plans moving forward? I'm curious.
So I haven't bought a share of anything long all of 2022, and I don't plan to until I see SPX print under 3,000. That was really my mindset. I can't say I'm certain, but I'm of such strong conviction that we see sub 3,000 print. That's where I would start taking the risk of DCAing into some names that I really like. Would be under that, because to me, the time in the market versus timing the market, that's great if you're DCAing into like a 401k and you're just buying an index fund every single month, right? It's safe. You realistically are just betting on the economy growing over the course of your life. And so if you're DCAing into a retirement account every single month, even if you bought March 2000, you also bought April 2000, you were buying ups and downs. And so in the long run, that's all you're doing is betting on the economy growing over the course of 50 years until you retire. I think that's a very smart approach for 99% of people. But for me, especially considering I'm in the markets every single day, I'm personally not really looking to buy anything until I see sub 3,000 SPX print. And then I'll go into the individual names that I like that I think have a great moat. The couple names that I personally want to own for the long run. And that's where I'll start buying.
Like what?
I'm with you. I love Google. I'm going to take some stabs on semis. I love NVIDIA. NVIDIA owns, I think it's 55% of the total semiconductor market cap. It's just absurd the amount of business they're crunching through. So a lot of those names, I don't really know how AI itself takes off, right? I want to love Meta, but I can't yet. But I want to be in names that'll have an arm in that. And so when I look at a name like NVIDIA, they're already generating great cash flows right now. And those will be the names that'll also explode. And if the AI thing takes off, you have gaming consoles, you have supercomputers having to crunch all the data, they'll also be in that boat to really profit from that. Google's another one. I think just a database like that, you have YouTube revenues coming in. YouTube grows every single day. It's unbelievable how much content is consumed on a daily basis. So those are some names I really like. Probably I'll sprinkle some into financials and utilities just for your safer holdings, maybe a couple of consumer staples. But those two are the ones I'm really excited to get into, which sucks because I'm not letting myself do it anytime soon. To me, especially, right, if I start DCAing here and SPX prints under 3,000, that's now for SPX, if I buy these names, assume they run linearly, right? That's now over 20% updraw I would see back to break even.
Hey, Noah, what do moving averages, RSI, and MACD all have in common?
They're all lagging indicators from the 70s with weak ability to predict future price action.
Exactly. Modern retail traders need modern trading tools. That's why we've partnered with Rocket Scooter, an artificial intelligence and algorithmic charting tool that predicts where high volume will occur before it happens.
That's right. Rocket Scooter's 15 unique indicators help visualize in real time where institutional players are interested on almost any stock and gives you a clear-cut game plan for how to take advantage of the underlying mechanics of the market.
A platform like that probably costs a ton of money.
Well, for 7 days, Rocket Scooter will offer their groundbreaking technology completely free. Then, once you decide you're ready to become part of the Rocket Scooter community, for a limited time only, Rocket Scooter is offering 50% off their monthly subscription for life, as long as your membership stays active. Go to rocketscooter.com and sign up for the monthly membership using coupon code WOLF and lock in this rate forever before it's gone. That's WOLF, all lowercase.
All right. I have a question here. So you have very, very strong conviction. I'm curious, what would have to change in the macro environment? What would you have to start hearing from the Fed to admit, okay, maybe the drawdown in equities that I'm expecting won't be quite as drastic, and I think it might be time to buy some stock? What would you have to hear? What would the environment shift have to look like for you to admit, okay, I think I was a little bit off?
I think that's a really good question, because price targets in and of themselves they're kind of fugazi, right? Who knows what's going to print? That's not really what I'm looking at. Those are just like, to me, this is where I think we would print if, XYZ, everything I'm expecting to happen in the macroeconomic environment happens. I think 3,000 is a conservative low ballpark of where we could bottom. It could get uglier beyond that if you see some significant capitulation from people that have been long for a long time and are now back to red. But ultimately, it's all based on the Fed, right? And I don't know why it took me so long to understand this. The Fed is what's going to move markets based on what they do with their monetary policy. And so one of the key indicators I'm watching at always is the 2-10 spread, the near term, the 3-month 10. For the past, I want to say 4 or 5 bear markets where you've had 2-10 inversions forecast the recession, the 2-10 spread has then printed back positive and uninverted before bottom was in. But then ultimately, in the near term, I think it was like a 7-month on average before bottom was in. And so the first thing I'm even going to consider is the 210 has to uninvert before I'm even considering buying anything. And odds are that's going to happen before bottom's in anyway. But that'll be one of the first things I'm looking at, is to see the yield market start to forecast that, all right, things might start getting better in the nearer term, right, within a year. And that's where I would start even considering. But right now, the 210 spread's at like 40-year lows and still falling. The 210 spread might go under 100 basis point inversion, which is just unbelievable. So that'll be the first thing I'm watching. And then it'll be really on monetary policy. The Fed pausing rates doesn't really mean too much to me, because they could pause rates and then ultimately inflation still remains sticky, right? Them pausing it is just because they know that monetary policy is going to take time to be felt. And so that would just be more of, let's stop hiking so we don't send ourselves into like an insane Great Depression, but see how things pan out. That still leaves the case where they could pause rates and inflation remains sticky a couple months down the line, and they have to continue hiking again, right? There's no like exact algorithm of how to fix this, right? It's trial and error. And so they're going to keep hiking. Then they're going to wait a couple months, see how the data reflects it, and then go from there. It's very fluid. And so the pausing isn't going to mean too much to me. I think I would have to see a full pivot. But if the pivot is based on unemployment skyrocketing, as Diamond mentioned, like if they get to the point where they hiked way too hawkishly too fast, and we get to the point where everything kind of like, snaps, layoffs start getting really drastic and unemployment starts cranking, then we're going into full recession. I'm not going to be in a hurry to buy that either, because that'll probably lead us to a couple months of recession before the markets get to that point where they kind of pivot back. So I don't know, like the Fed, I'm very fluid with it, but the 210 spread will probably be my number one thing. Until that gets positive, I'm not looking to buy anything.
It seems like everybody is kind of on the same page for like 2023, and that's almost like a position of safety, right? Where it's like you have short rates that are expected to go to 5 like by the end of the year. Like you can get a 5% risk free just by doing nothing, right? You don't have to go out and try and pick stocks, try and time the bottom in the S&P 500. You can just get your 5%. And for somebody who's, maybe doesn't have the time horizon that we have, the investment horizon that we have, 30, 40, 50 plus years, that's really, really attractive, right? And so for a lot of people, and you can imagine that's where a lot of the wealth is concentrated, right? On that, sort of end of the age spectrum. So it's like, what's the case to buy stocks for those people, right? I mean, for us, it's a little bit different where, I want to be invested. I understand that over the next 50 years, there's going to be ups, there's going to be downs and X, Y, Z, but I want to be invested, right? That's what we do know from what we've seen so far, right? You got to be invested in the market from a young age, and over time that will pay dividends, right? But if that's not your situation, if that's not your investment horizon, you've got a case where you think the market's going to go down, so you want to have some cash, you want to have some dry powder on the side, and then you also look at the rate environment where rates are meaningfully high for the first time in like decades. So it's just hard to make a case for, I think, most people right now to like want to buy stocks, which is, I guess, sort of goes exactly hand in hand with those price targets that Manders got set in his 2023 outlook. So it's going to be really interesting, I think, to see how this year plays out.
The only reason to buy stock is because there are no reasons to buy stock. That's about all you can say.
There's a lot of hopium still going around too. That's another good reason to buy stocks. But I think you make a great point. And what's really crazy to me is we've seen the 10-year over 4% for the first time in, like you said, decades. And there was still minimal bids on it, which is like incredible to me that, you know, what was the 10-year yielding for a long time? I think it was in like the low twos, if barely 2%. It's doubled in yield and people still don't necessarily want it. And there's a lot of people in your exact boat where if you're nearing that retirement age, you're definitely not looking to slam down in the stock market. You already made your money over the past 50 years. Now it's about conserving that capital and getting what you can in a risk-free environment like that. So unless the government defaults and the central bank defaults, which likely never happens, you're guaranteeing yourself a risk-free 4% annually for 10 years. I thought a lot of people would want to gobble that up, and evidently not, because there's so much uncertainty in the near term. And plus, if the Fed, so 17 of 19 members on the December recap there, their 2023 projections, 17 of 19 members projected an end of 2023 upper bound on the federal funds rate of 500 basis points or higher. And right now, I think we ended the year at 450. So let alone the pivot narrative, like every single of the 19 members said that we're going to end 2023 higher than we ended 2022. Not a single one saw a pivot in the forecast. And yet the markets are still pricing that in. It's like, I don't know what the Fed has to do for people to take them seriously, but this Powell put idea where the Fed's just going to come in and bail us out, like it refuses to go away.
Well, I think people look at the situation not so much in terms of the Fed's resolve, because like you said, the Fed really has been pretty resolute in their, positioning against inflation, right? And I think that has come to a bit of a surprise for a lot of people. But I also think the market smells a rat in the sense that you're not going to have terminal rates at 5 and some of these absolute dog shit companies with their debt trading at like 11-12% survive. Like most of those companies are going to go to zero. And so like unemployment starts to pile up, and that's where it's like, okay, you can say now that, yeah, we want to bring rates to 5. You could say now we want to bring rates to 6. But like what happens when the rubber meets the road and there's blood in the streets and we're at 4 or 5% unemployment? Like can you still be that resolute? Right. So I think that is the situation where people are like, yeah, this is what you're saying, but things can change. And when things change, you're going to change. Right. So I think that's where maybe the market is kind of calling Powell's bluff. And like I said, like who knows how that plays out, but I don't know, man. It's gonna be very, very interesting, especially I think towards the second half of this year to see like how all of this sort of comes together. People are still betting on the American consumer to really remain so strong, and as Mander has said on like 5 different beat the bells, you have credit card debt literally at all-time highs. As your rates are coming up, like you got a lot of different catalysts that I think really meet at a head here in 2023.
If there's one thing that we learned in 2022, and it's something that we already knew, is don't fight the Fed. And I remember very early on in 2022, everybody was in that sort of mindset of, no, this time will be different. Yeah, but this time will be different. Everybody at this point should be, they should have realized that don't fight the Fed is still a tried and true thing to sort of live by and to invest by. And so into 2023, that's really what my main focus is as far as investing. And Mander put it really well. The Fed is obviously data dependent. So we have to be open to what is actually going on in real time and understanding and interpreting that data along with the Fed. But again, like 2022, that was the number one lesson to be learned. And it was a lesson that we have learned over history. So it was at no surprise. But again, like Noah saying, the markets are calling cap, right? The markets are pretty much saying, yeah, but this, but no, we think you guys are going to do this. I think it's one of those proceed with caution type mindsets, because so far that has not boded well for people. Just being very, very careful that don't fight the Fed is a very, very legitimate thing, and it proved to be true in 2022. That's a massive, massive lesson that I think people learned, despite that hopium of no, this time will be different.
I feel like a lot of people still haven't learned it though. So I just went through the minutes release from the December meeting. It was posted like just over 20 times. The reaffirmation of their dedication to getting inflation down to 2%. They reaffirmed it, and the start of every single paragraph. They said we're resolute in our conviction to get inflation back down to 2%. Powell was asked in a press conference, would you guys ever consider raising your target rate of 2% for long run inflation if inflation stays sticky over the long term here? Not even considered, right? And so they're going to be resolute, whether the markets want to accept that or not. They are going to be resolute in getting inflation down to 2%. So now it's really, how much monetary policy implementation does it take to really destroy this demand side of the equilibrium to get us there? Because right now I think we had 2 months of negative month over month inflation last year. 2 out of 12. And it was like a minus 0.1 and a minus 0.2 or something, right? So it's really over the course of last year and all this hikes, inflation really hasn't budged. And as we get into 2023, you're going to see your year over year comps probably come down because it was from such extremely elevated levels. But how much does the month over month come down? That's really what you want to see consistently negative to show you that month over month inflation is coming down. The year over year is going to be skewed, but...
Maynard, let me ask you a question, because I've been thinking more and more about this since we really started hitting on that in like November, December. And you're right. Obviously, when we get into, really starting like now, when we're comparing inflation year over year numbers, like obviously inflation last year was high, right? So when you have those types of comps, it's going to look better on a year over year basis, right? Looking at inflation, especially coming into the early part of this year, like when CPI had sort of peaked last year. But where do you kind of sit on the sense that we don't need inflation necessarily month over month to start coming down? Like, what if it just takes longer than expected? Because even if you have a situation where inflation year over year comes back down to 2%, even though it's against those high comps from last year, that still puts you in a situation where inflation is sort of moving at a expected pace, although albeit elevated, right, from last year. Still, it's not really like, it's not where the money supply is not inflating more than we expected, right? In that type of situation, it's like, what do you think about that? Where it's like, that may not be the worst thing in the world, right? Like, as long as things aren't getting worse, they're getting better, is what I'm trying to say.
But are they?
That's what I'm asking you. Are they? Like, I don't know. Like, how do you feel about that situation?
I don't exactly know how the participants look at this, if they only want us to get back down to 2%, or with an entire year of almost quadruple the CPI, the target rate, right? We were at like 9.1 at peak, and then I think we averaged somewhere in the 8s, right? So we were quadruple
right,
the
but
target
they
rate.
always say it's they're targeting that average. How long before that was inflation below 2%, right? There was a point where inflation was at 1%, and people were like, the Fed is not going to be able to get inflation back to 2%. Like, that was a real concern. They were like, we want to average inflation at 2% over time, right? And then inflation was at 1%. Everybody was freaking out. Inflation goes to 3%, and Jerome Powell's like, guys, it's transitory, completely fine. Like, it's running hotter than expectations, but we were running below expectations for so long. Like, this is okay, right? And then we started to creep up into that 5, 6, 7%, and people started to freak out. That's why I'm saying, like, I don't know what that would look like in terms of like people's response over the next year. Like, if inflation didn't necessarily get worse, it just sort of remains sticky at this level. Like, what, like, how does that shape up for the markets? Like, I feel like that just puts us in a situation where we could have like 5 years of just like chop. Like, we could just be sideways for like a long time here.
There's a very good chance. And I think that's a very realistic possibility as liquidity dries up and no one is in a rush to jump in front of this. Like, I think every recent investor and trader after coming out of 2020, there was a lot of new people getting into the stock market. A lot of people are of this mindset that we're going to have this really sharp decline and print wherever we're going to print, and then it's going to just replicate, right? And we're going to go from 3,000 to 6,000 over the next couple of years. that's realistically not what's going to happen, right? This is going to take a lot of time. We could trade sideways for a lot of like years. It's very, very possible as this takes time for the economy to start doing well again, start for companies to start being profitable again, right? It's not going to happen overnight. And so I don't think we see a scenario where we drastically landslide to 3,000 and then boom, over the next 2 years, it doubles again to 6,000. What we saw in 2020 to 2022 was unprecedented. It's never happened before. And it was really based off of us already being in this low inflationary time. Like Diamond said, we were at a peak economy where they would have wanted to start tapering down the growth at that point. And then COVID smacks and we get put in a situation where it gets prolonged for 2 years with additional QE, with additional stimulus checks getting sent out to people. So that's really where I think we're at this point. We just have a lot of, it's kind of like a perfect storm to me winding up here where we have rates getting hiked unprecedentedly high at the fastest. We had the most rate hikes last year in a calendar year ever. You have the credit card debt crisis that we've talked about, right? Consumers are going to be dried up. When does delinquency start coming into play when you have these interest rates getting so high? You know, companies with all the hiring they did going back of the COVID pandemic because business started booming, you had unprecedented employment come in and like unprecedented jobs added to the labor force. It's kind of just like this perfect storm where I think something has to give at some point. But in terms of inflation, I think you make a good point that I don't necessarily think we have to get into a deflationary situation where you start seeing negative prints for a prolonged period of time. I don't think it has to be like an 8% last year, so we need to see multiple years of like a minus 2% deflationary situation. I think it could just be where they get it down to a 1, a 2%. But if that's the case, it's going to be years and years and years of that. And they're going to monitor monetary policy accordingly. If that's as low as they can get it, it's going to be years and years and years of that to really get us to that long run target rate.
I want to switch gears here to start to wrap up the show. Let's talk about Kane Cap plans for 2023. We can talk about the Discord, your Twitter, YouTube, whatever you want. What are you envisioning this year? What are you most excited about?
Beat the Bell has to be my number one excitement, man. I'm loving doing this with you guys. Like,
yeah,
every single episode, I have fun planning for it the night before. Like when me and Diamond meet to prep the Fed forecast and we come up with a new topic, like I get juiced the night before. I can't wait to see where Beat the Bell goes in 2023.
For our listeners who haven't gotten the chance to see us on Beat the Bell, it's our morning show that we started, I want to say like a month and a half ago now. And we're doing it every Monday, Wednesday, and Friday at 8:30 a.m. Eastern. The Twitter account, if you want to follow along, first off, we stream it from the Kane Cap Twitter account, as well as the Beat the Bell show. It's at Beat the Bell show Twitter account. We're on YouTube as well, the Kane Cap YouTube, and we're on Twitch, Kane Cap Twitch. So yeah, that's something that we're very, very excited about. It's starting to garner more and more traction, and hopefully in 12 months from now, it's way bigger than it is right now. But we're still getting thousands of people tuning in a day. It is awesome. It's awesome. Very, very excited about that.
Pretty much exactly, this was a prolonged conversation of basically what you would have every single morning on Beat the Bell, live 8:30 to 9, Monday, Wednesday, Friday. It's the funnest thing to me, just getting up there with Diamond and talking our shit every, 3 times a week, every morning. And on top of that, really, I'm just excited to see where the trading year takes me because I know, especially after this conversation, right, things seem very grim in the market. I'm really excited whether it's a great year of profit or whether it's a great year of learning experience. One way or the other, I think 2023, especially as I look at this as a holistic career, right? I want to be trading and I want to be doing what I'm doing for the next 40 years. And so I think whether it's, I take a bunch of money from this year or whether I take a ton of learning experience from this year, it's going to be invaluable one way or the other. So I'm just really excited to see how I come out the other end. If we do this again in a year, I'm sure I'll have a lot more to talk about and a lot more lessons learned because we keep learning every single day in this game.
That's a great mindset to carry. I put out a tweet the other day. As you mentioned, everybody right now when thinking about the market is kind of gloom and doom. And 2022 put a lot of people in a mindset of, this shit just really sucks. And it did, honestly. It was a tough market to trade. Every trader, regardless of experience, learned something in the year 2022. And it certainly wasn't as easy to trade as it was in the year 2020 and 2021 when things were just rocketing everywhere. But carrying that mindset of there's a really good chance that the market is going to suck today, suck tomorrow, suck next week. It might suck for the entirety of the whole year, but showing up with a good attitude, ready to learn, ready to trade, that alone is invaluable. So when you think about, as Mander said, we want to be doing this for the next 40 years. Like this is our mission. Like this is our career. I don't see anything else. There's really no option for me to say, oh, the market is shitty. Like I'm just waiting around for things to get better. I'm prepared for whatever is to come. And I think that that's really the only way. And I don't want to just say survive, because we're not trying to survive in this market. We're trying to do well. We're trying to outperform. We're trying to be extremely profitable. So the mindset, I'm going to carry that throughout the entire year. Like it's something, if you're struggling and you were down because of the way the market in 2020, you feel the way the market in 2022 treated you, and you got whipped around a little bit, switch that mindset, right? Like make it more so I'm excited for what's to come, because I'm excited to face what is likely to be a difficult time, and I want to see this as an opportunity to get better. Mander put it perfectly. We don't know if this is going to be a year where we're extremely profitable and we're able to make a ton of money. But what you can guarantee is that if you're putting in the work, you're going to be able to learn something. And over the past 6 months, in the second half of 2022, I learned more than I had over the few years previous that I had been trading, just in those 6 months, because things really started to get tough. And so a lot of strategies that we were using even early in the year, they had to be adjusted, and you had to get smarter, and you have to manage risk better. And I'm very, very happy that I'm able to live through this and trade through this, because not only have I learned how to become a better trader, but mentally, there were a couple times last year where I was, definitely down in the dumps, and I was struggling mentally, and I was like, man, like what is going on? Like I've traded the same way for so long, and now things are just like, it just became very, very difficult. And I use those moments to not necessarily learn about the market, although of course I learned about the market and I was able to improve my strategies, but to learn about myself and to learn how I can manage my emotions when I get in those situations. And I'm learning that as hard as it is, when things get really, really hard and you want to be negative and you want to tell yourself, I can't do this, and the market is fucked, and the market is doing this to me, I hate the market, I like that mindset is horrible. It's horrible, horrible, horrible. You have to be open to learning. You have to study those moments when you feel like shit and you don't want to keep going and you just want to give up trading, or things just got too hard. Study that. Study what you're feeling like in those moments, and then study how you can do things differently the next time it comes around, because it will happen. I mean, Noah and Mander will tell you, I'm sure they've had moments where, the trading got horrible or they lost money, and then things get good again, but then you never know when it's going to come again, and it will come again 100%. I'm telling you, there's no finish line to it. It's not like you just all of a sudden the switch flips and you never go through another drawdown in your account. Like you have to be prepared. So use those moments where you are struggling to your advantage and say, oh, this is good, because I'm going to learn about how I can handle these situations moving forward. So positive mindset all of 2023, guys. We'll be talking about that a lot on the podcast. No negative energy 2023. I don't want to hear anybody down in the dumps.
No negatives.
No negatives. None at all. Mander, appreciate you joining us. This was a sick episode. I learned a lot. I was sitting here just kind of soaking in everything you had to say. We are in for what is likely to be a very volatile year. A fun year, I think. I think it's going to be good.
It'll be something, that's for sure.
Yeah.
It'll definitely be something. Thanks for having me on. It's always a pleasure hopping on with you guys and chatting it up.
Yeah, thanks for joining us, brother. Really appreciate you. Noah, another solid episode. See you next week for episode 60.
Kick-ass episode to start the year. Thanks again to Mander, and we'll see you guys next week.